Okay, today we're going to talk about the infinite banking concept. My name's Harper Jones. My company's Life with Leverage. You can see the website and my contact info at the bottom left there. And the infinite banking concept, what we're going to do is we're going to talk about it conceptually. Then we're going to kind of funnel it down into how we can use it more mechanically and how it's designed, and then maybe some use cases that you could use it in, or what I see current clients or myself using. Quick disclaimer, I am not a CPA and I am not an attorney. So let's get right into it. How to build your own banking system. So 3 main things here. Why you want to escape the traditional system, what the traditional system is hiding from you, and how your bank will outperform conventional banks. So if we're going to be talking about banking, let's go ahead and define that word. Now, if you look it up in the dictionary, the definition is something along the lines of the business of a bank, originally restricted to money changing and now devoted to taking money on deposit, subject to check or draft, loaning money and credit, and any other associated form of general dealing in money or credit. Okay, well, what the heck does that mean? That's just very elaborate definition and response. Well, essentially, a bank lends your money that you deposited there, earns interest, and gives little to none to you. And this is one of the problems that infinite banking solves. The problem, lost opportunity cost. You finance everything you buy. You either pay interest to someone else, or you give up the interest you could have earned otherwise by paying cash. There are no exceptions. Traditional banking and infinite banking. Let's compare the two. In traditional banking, you're heavily taxed, and your compounding is interrupted by taxes or just moving funds in and out. Infinite banking, tax-free, and there's uninterrupted compounding. Very powerful. In traditional banking, the bank makes the rules. In infinite banking, you own the rules. In traditional banking, there is a markup on the interest rate. They have a cost of capital and they're marking it up so that they can profit and run the business. In infinite banking, there is no markup on interest rate or very small because you're also an owner of that system and not just the customer. In traditional banking, it's not creditor protected. In infinite banking, it is heavily creditor protected. In traditional banking, there is no death benefit. In infinite banking, there is death benefit. In traditional banking, it's not guaranteed. In infinite banking, you have very strong guarantees. What is the infinite banking concept? The infinite banking concept, or IBC, is the process of becoming your own banker. We will show you how life insurance policies can function as dividend-paying assets through accrued equity, and the many creative ways one can utilize this liquid cash value. The cash value is really the cash that you can access in your infinite banking system to be able to leverage that to build and grow more wealth or finance different things in life. A fantastic book from the man that discovered the concept of infinite banking. He wrote a book a couple decades ago called Becoming Your Own Banker. The author is Nelson Nash, and that is a book that really outlines the foundation of infinite banking and is great to read. You know, I like to read it maybe twice a year, even though I'm always talking about this. It is a great book to stay sharp on the concept. How can we use the infinite banking concept? Number one, it is a forced savings vehicle. It forces you to pay yourself first. When you have money come in every month, you immediately send it out for your bills, or allocate it to reinvest, or it sits there and finds its way to linger out of your accounts. What we want to do is forcefully shift our cash over to our infinite banking system right off the bat, which allows us to have more cash at the end of the day. You can finance a down payment with your infinite banking system or an entire real estate project. You can escrow your property taxes and insurance premiums to recapture lost interest and build wealth rather than the bank when they're escrowing it and they're lending it out and making profit. You can use it as a place to hard money lend policy from your system. Essentially, you're going to have cash in there and you're able to leverage against it and lend to other people. It's a great place to sit cash for a liquidity event. You can use it to finance your business instead of using a third-party line of credit so that you ultimately control the line of credit and draw on it at your leisure without that ever being called or having to renew it, and at a very competitive interest rate. It's a fantastic place to sit reserves. It's perfect for tax-free passive income later in life if designed properly and funded properly. And it's also fantastic to offset estate taxes and great for generational wealth transfer down the road. Now, it's important to understand there's a platform involved and a process to operate it. A couple examples here. A platform is a bench press. The process would be building muscle. A spoon, and the process would be eating cereal. And a hammer is a platform or a tool, and the process is building the house. So we got to separate the two in our head. Saving versus investing. Savings is like the pond, the storing of wealth in a safe liquid form so that we have access when we need it for whatever that might be, investments or financing something else in life. And investing, that's really the stream that keeps paying us, and that's us growing our wealth through strategic actions. There's definitely a difference between the two. Now, platform, our self-pay account, where we're shifting capital over to so we can warehouse our wealth before we deploy it. So our ideal savings vehicle to warehouse our wealth. Now, what does the ideal savings vehicle look like? Let's look at some of the attributes that we would like, some of the characteristics. We like a competitive rate of return. We would like guarantees. We definitely need to be liquid, not tied up. We would love for it to be tax-free. That's why it's highlighted in orange, because for me personally, I like my money to be a little more tax-free. Credit protected, very important. And we'd like it to compound uninterrupted so that can really grow over the years. Now, what vehicles really hammer out all these attributes and incorporate them all? The platform we used to use is a specially designed life insurance contract with a mutual insurance company. Now, why do we partner up with a mutual insurance company? Because they're one of the largest entities in the world, and we're able to share in the ownership with that mutual company. Now that we have the platform established and what we want to use, and we'll dive into some more of those specifics a little bit later, let's shift over to the process. Infinite Banking Concept, or IBC. This is a process, it's not a product. And the process is leveraging our ideal savings vehicle, or the self-pay account, to build more wealth. Now let's define those three words: infinite banking concept. Infinite, only limited by your imagination. Banking, process of controlling the flow of money from a pool of capital. And concept, this is really a new thought process on a way of thinking. Velocity of money. When we have a dollar and we go put it to work somewhere, if we can reuse that dollar or re-velocitize that dollar, we're going to make much more money. So let's say, for example, we could go get a return somewhere, but we could turn the dollar over and get another return. Well, throughout the year, you're going to get a high rate of return. And it's all about reusing that dollar and the volume of how many times we can use the dollar, right? So money in motion, velocity of money, that's really IBC at its core. and having full use and control. We're able to recycle our dollars and reuse them, make more money. Just like a bank lends out a dollar and then they re-lend it out before they get the full loan paid off, they're recycling the same dollars. That's what we're doing. Now that we got through some of the concept, let's go into some of the mechanics. Now, as you see at the bottom left, we got savings. At the bottom right, we got investing. So see it kind of as a T-chart, where our savings typically is in a checking account or a savings account or something of that nature. What we're wanting to do is shift our savings into a specially designed policy with a mutual company. And that policy is going to have cash value. That is our liquid cash, our liquid savings in a tax-free environment that is credit protected and that we have an ability to leverage against and access for our investments over here on the right. The policy is also going to have a death benefit, illness protection, and like I said, creditor protection. That policy would be placed with the mutual insurance company because we're able to be a customer, but also partake in the ownerships and the profits of that company. Because there are no shareholders, the people that have policies with a mutual company get to partake in their pro rata share of the profits and growth. Now, us over here, or you, are able to access virtually 100% of that cash value. And the preferred way of accessing, although there's a handful of different ways, is to leverage against it. Because in life, when you have leverage with people, if you have leverage with money, that's really how you're going to multiply your wealth more, right? Or leverage with skill set, so on and so forth. No difference here. We have our money in our policy, growing, tax-free if handled properly, uninterrupted. We're able to borrow against it without stopping that interruption, merely by getting a line of credit against the policy. And we can get the line of credit from different sources against the policy, pledging it as collateral. But the preferred method is to do that with the mutual company. You can fully control the line of credit, and they will loan against your cash value. And you'll get the funds in your bank account, right? Your checking account, to go put it to work. When we have those funds and we go put it to work, let's look at the flow here. We're able to use other people's money, insurance companies, while yours is still compounding. Full and entire use and control, no credit check, no none of that. It's going to be entirely interest only, and you can choose how to pay the interest back, when, and the principal. But of course, us as Infinite Banking coaches and advisors, we're going to show you how to do it and what parameters to stay within and be here as a resource. And then when we have the funds deposited in our account, let's say, for example, we want to use it to buy some real estate. Awesome. That real estate will cash flow back to us. And we can decide, do we want to pay back our line of credit against our policy? Or do we want to keep deploying that and recycling that dollar, right? Being put to work over here at the left. Now we're putting it to work on the right. Hey, let's go buy a business. Business will cash flow. Oh, hey, we have an opportunity to fund a venture for someone short term, get some good interest. All right, we'll loan it out. It comes back. And then escrow. Money comes back in, and let's say, oh, we got some taxes to pay. Well, instead of sitting that at a debt account at the bank or letting the bank escrow it, why don't we just put it in our own banking system, earn some interest and profit off that, and grow our own banking system even more? Well, great idea. Now, as you see all these assets over here, you're going to have a rate of return. They're also going to have a rate of cash flow. And then you'll see this little diagram up here that we saw with the other slide before, how we're having velocity of money in motion, and showing how this is truly infinite banking, is the flow of the money here is infinite banking. But the policy here is our preferred platform to practice infinite banking. Now on the left side, the policy is going to have a rate of return. And then, of course, we're going to have a legacy rate of return with passing the cash on to the next generation, and so on and so forth. Important to note, the policy is an and asset. When you have your policy or infinite banking system, you're leveraging against it. So instead of having cash in a bank account, and then the cash in the bank account, or you have the investment, you're having the cash in the policy and the investments. Assets typically in businesses are more tax favored. I am no CPA, like I said earlier, but if you're borrowing from a third party and it's used for a business purpose, you should be able to deduct the interest you're also paying to the mutual company. Now, life insurance efficiency spectrum. Let's say, Harper, how are we going to design this? We see some mechanics of how to use it. We're starting to understand the concept. How are we going to design it efficiently? Well, our focus is to keep all the growth within the policy tax-free and without restriction. So there's certain parameters we have to stay within. Now, in a couple of slides, I'm going to have some acronyms explained out in the top left, so it's easier to follow along. So let's go over them real quick. A one-pay or one-time premium payment. A PUA or paid-up additions rider, PUA premium. DB, death benefit. WL, whole life insurance policy. UL, universal life insurance policy. VUL, variable universal life insurance policy. IUL, index universal life insurance policy. MEC or MEC, modified endowment contract. QP, qualified plan. Now, when we're looking at the efficiency spectrum, we're looking at it from a cash value perspective or efficiency of our cash within the policy. So we have least to most cash efficient. The least cash efficient would be term insurance. You put $1 into term insurance premium, you have $0 in cash value, and you have a lot of death benefit. Now, term insurance can be great to have coverage instead of none, but you're not going to be able to have that cash accumulation and practice infinite banking. Now let's look at the most efficient. It's what's called a one-pay policy or a single premium policy. You put in $1, you get about $1 in cash value and a little bit more than $1 in death benefit. No more premiums or cash is needed throughout the years, just that one payment. And it's going to have all the benefits of growing tax-free and being able to borrow against it and so on and so forth. Except the government stepped in the 1980s, and by 1986, they disallowed that with all the preferred benefits. So you can still have the single premiums in the one-pay policies, but you're going to lose out on some of this tax-free growth and flexibility, and there's going to be some restrictions. So we don't want that, because everything that crosses that threshold, and we'll get to how we stay within the threshold in a second, is really treated more like a qualified plan, and we don't want that. Now, a traditional whole life policy is going to be much more efficient than a term policy, but still, it's going to be kind of like a car without a turbo. A little bit of horsepower, takes a little bit to get going. Or like a fire you're starting, and maybe you need a little bit of a fire starter or gasoline to get it going, but we don't have that yet, right? So you're going to have some accumulation, some growth, but how can we design that to be more cash efficient? Well, there is a rider, just like in car insurance or property insurance. There's different riders you could add to your policy. Maybe a liability rider, flood insurance rider, so on and so forth. Life insurance is no different. We can have what's called a paid-up additions rider, which is awesome. That paid-up additions rider operates just like a one-pay, but in smaller increments. You put in $1 in premium, you get $1 in cash value approximately, and what we're doing is blending those together. Now, there are a couple other products I want to touch on. Universal Life, Variable Universal Life, Index Universal Life, all those different products. Whole Life's been around for a couple hundred years. These other exotic products have only been around a handful of decades. They can be great if you want to have a side investment or something, but we don't want to pair our insurance and our safe harbor capital with something tied to the market and some other risk. If it's something that you guys still want to look into, I have other resources who could talk about why we don't want to use that as our platform to practice infinite banking. Now, with that said, the typical blend or ratio we like is about a whole life of 40% every dollar we put in, and about every dollar we're putting in, 60 cents of that dollar is going to go to that rider, and we'll put those two together, and that's going to blend to make our cash as most efficient we can without crossing this MEC threshold, or modified endowment contract. Now let's look at actual policy design, and let's look at an example of a $100,000 premium. So in this slide, there's death benefit is not listed anywhere. I want to keep it clean and easy to follow, and we're going to show $100,000 going in overall. So we got $100,000 premium. That premium is going to be made up of 60% paid up additions and 40% whole life premium. Here's a couple more acronyms: CV cash value, PUA paid up additions, PUA premium, whole life base premium, PUA turbo in the car, whole life horsepower in the car. We're going to look at years 1 through 4, or 1 through 5, and then skip to year 10. In this example, you put $100,000 in, your paid up additions, dollar for dollar, just what we talked about. You put in 60, you get about 60. Do that till your hand falls off. And then in the whole life portion, you put in 40, you maybe get $2,000 increase for a total of $62,000 that year. And this isn't cumulative, this is per year in this column right here on the last right side column. But someone say, well, Harper, I still have a little bit of cash drag. I put $1 in, I don't get all the dollars back. But you're really investing in a business, starting your banking system. And if you want to be profitable just like a bank does, it's going to take a couple years to get going. And there's only so many so many variables we can move around to keep it in your benefit. And I highlight this box in green because this whole life premium right here is really what keeps your business going, which really keeps it compounding over the years. So year 2, you put in $100,000. Same thing here with paid up addition, 60 in, 60 available. Whole life portion, you put in $40,000, maybe it increases $35,000 for a total of 95 cents on the dollar. Much better. And when you factor in that this is all in a tax-free environment, you're establishing a system that's credit protected, and you have a nice hefty death benefit, not illustrated on this page here, starting to get pretty much break even by year 2 and year 3. By year 3, flowing 100, you have 98 available. Year 4, flowing 100, maybe you have 101. Oh, wow. Okay, so this is starting to leverage for me, starting to work. All the while, I'm able to borrow against virtually 100% of this each and every year. Year 5, we drop off that rider. We drop off the fuel to the fire. We drop off the turbo on the car because horsepower is kicking in. It's getting efficient. It's maturing. We put in 40, goes up maybe 45. So at this point, write a check for $1, and it's going up, $1.10, $1.12. Pretty good for a total of 45. Year 10, put in 40, going up 60. You write a check for $1, turn around, write your check for $1.50. In this scenario, how many times you want to write that check, and how big of a check do you want to write? Because you're getting all that back tax-free, and now you have a system that's paying you, and this is your savings system, right? This is your warehouse of wealth. This isn't your investments that are going to complement this, right? So let's look at an actual example. I'm going to zoom in, and you're going to see on this slide here, this is just a male, age 45, decent health, and he's just funding his policy annually, although you're able to fund annually or monthly or a hybrid of the two, so there's a lot of flexibility. Same setup. We're going to fund 100 for 4 years and drop down to 40 and on. We have a cumulative outlay, right, of what we're funding. This is the per year premium. This is cumulative premium and cash we're putting in. Annual dividend, cash surrender value increase per year, cash surrender value cumulative, and death benefit overall. 100,000 year 1. Dividends very low in the beginning because this policy is with the company called Emeritus, and they're a mutual company, been around since 1887. And their policy is called Emeritus Access Whole Life. It was actually designed for more access to your cash value, and I was actually on the product team or one of the people that helped have some input for this policy and this design. And it's shifted more to the guarantees, essentially. So you're having good cash value growth, but they give you more guarantees and less of a dividend. But overall, if you compared it to other insurance companies, their product actually might outperform, even though the dividend is a little bit less. So just keep that in mind because I get that question sometimes. So you put in 100, cash surrender value increase that year, 62. Total or cumulative is the same as first year. and then death benefit 2 mil. Okay, great. Year 2, put in 100. It's going up about 95 cents on the dollar for a total of almost 156, and then 2.1 million in death benefit. Year 3, put in 100. It's going up about 95, 96. I'm under the column cash surrender value increase, and then I'm looking at row 3 there. Then year 4, put 100,000. It's going up about 100 and change. As you see, it's 100,555, and then total cash value 352. At this point, your policy is starting to mature. Your death benefit now has creeped up about $500,000 from 1.9 here to 2.4. We drop off that rider. Year 5, you put in 40. It's going up about 49,000 for a total of 400. We're rocking and rolling. Every dollar we put in is going up like $1.20, even better. So 2.4 million and change death benefit. By year 10, you put in 40. It's going up 65. So we put in $1, it's going up like $1.60. So it's really becoming a powerhouse for you. You can put in $1, get more than that, and then go turn around and borrow against it. Totally 2.6 mil. It's just awesome. It gets better and better. You see by age 75, you put in this 40 here, it's going to 154,000. You have a total of 2.8 million and 4 million in death benefit. So in this scenario, you have double what you've put into this tax-free, because you put in about 1.4 and you have about 2.9. You have double what you put into it. All that growth is tax-free. You've been able to use it the whole time, and you have $4 million to pass on to your beneficiaries tax-free. Each and every year it gets better. If we go to age 95, let's just go to age 90. You put in that 1.4 million. You have 5.4 million in here. That's like a triple, right, or more. And then you have $6 million in death benefit, and this is your savings vehicle, right? This isn't, you're going to be leveraging this to build more investments, grow more wealth. All right, so what do we do for you? We handle a relationship with the mutual companies. We have strong, good relationships with them. We monitor your policies so you don't have to. We coach you on how to best utilize your IBC system, Infinite Banking System. We ensure you don't lose your tax-free benefits. We service you day to day, just like any life insurance agent would, but we're also going to coach you on Infinite Banking and be here as a resource on top of that. And we work with you to reach your wealth goals, whatever those might be. I want to go through a few real-life examples and how I've used my policy or how some clients have. So I'm in real estate. We own several storage facilities, industrial buildings, and mobile home parks. And there was this second storage facility we bought years ago, and the seller was going back and forth. I had some cash in my Infinite Banking policies, and so did my brother, and we were buying some together at the time, right? And the guy wanted $800,000 for this storage facility, and then he 2 weeks later basically said, "Hey, no, I want to back out of the contract. I would like to, take some money and keep an income stream, not have as much cash or taxes all at once." So essentially, the seller ended up seller financing the deal. We needed about $100,000 down, and he financed $700,000. We borrowed from our insurance policies, put the cash down for the $100,000. Turned around a year later, we're able to get our cash back out, and essentially that property appraised for 1.6. So we bought it for 800. It appraised for 1.6 million a year later after we put in the right work and got the rents up, fixed the property up. And we were able to get our $100,000 back out because the property was valued higher. We were able to keep the seller finance debt, get our $100,000 back out, send it back to our policies. And what was awesome about that is the only money we had in the deal was just the interest on our policy loan or line of credit we took against our insurance policy. So I was able to keep our policies, me and my brother, borrow against it, cash still growing within the policy. When we repay that policy loan a year later, we actually have more cash and cash flow that can keep funding our future premiums or pay back other policy loans and keep the system going. So instead of having that money sit in a dead bank account, we're able to put it in our own banking system and keep being able to recycle and redeploy for more deals. It's great to have personal tax bills sitting there and be able to borrow and leverage against that and have interest being earned on the tax bill and sitting it off to the side instead of a dead bank account. I did have a client a couple months ago. They had some taxes they were paying quarterly, and they said, well, this is just stupid. We're accumulating it over here off the side. Let's filter it through a policy. I'll get more insurance on my husband, and we'll be able to escrow those taxes and build a further banking system. So that was really, really cool. And some people are planning for passive income off their policy later. It's just really, really cool to watch people use their system and finance their projects in real estate and taxes and things in personal life. So a couple frequently asked questions. How much do you need to get started? It really does depend on your objectives. So I like to talk with people one-on-one. Hey, what are your goals and objectives in life and financially? And then we can design something and see what makes sense for you to start with. Can you have multiple policies on a person or own policy on their people? Yes. Is there a reason you would have multiple policies instead of one policy? The answer is yes. Your income may increase, so you can attribute more to a policy, and we need a new one. Maybe you want one on a spouse, kids, grandkids, great-grandkids, even business partners or employee bonus plans, some creative and advanced things. And that's something where if we had some conversations one-on-one, we could go through what your needs and situations are. Can a business own a policy? Yes. Okay, what if I can't fund the full premium in the future year? What if something happens, Harper? There's flexibility in when and how, and even reducing how much we're funding over the years, so it's very flexible. And then I get this question a lot. At what percentage will my policy grow? And to figure that out and nail down exactly what that answer is, I'll talk with you one-on-one. We'll actually design a schedule for you, and then we can look at the actual numbers right there on a call or in person. Now, hey, I want to get started. I figured out what I want to fund each year. How long does the application process take? About 25-30 minutes. That could be a phone call or a video call. Now, how quick can I get my infinite banking system started? Once we do the application, within 15-30 days, you could fund the first premium and be in full force. Now, next step, decide on how much you want to fund your infinite banking system with. You can reach out to me, email there, harper@lifewithleverage.com. You could call me right there, 865-803-7006. Happy to meet with you, talk through this, see if this is something you'd like to pursue in your personal life and business. I, for one, use it very heavily. A lot of people around me do, and I work with people all the time across all different states. So you could be in any state, and I can work with you. Now, when we do decide how much you want to fund, keep in mind we're funding it a little bit more top-heavy in the beginning, and then we're dropping down to 40% of whatever number we're choosing thereafter, and there's different ways we can design that and get a little bit more flexible. So you want to reach out, you want to talk further, there's my contact info at the bottom left. I am definitely looking forward to talking further.